welcome to ValueVest Daily. Today we're digging into a real head-scratcher in the cybersecurity world, a company called SentinelOne. We've got a business that's growing, it's making all the right moves, and some big-name researchers are calling it a massive bargain. But the stock? It's just sitting there, stuck in the mud. So what's the deal? We're going to unpack this huge disconnect and explore a potential path to a $100 billion future that might be hiding in plain sight. Let's get right into it.
So this is the central mystery, right? It's the question that got us interested in the first place. On one hand, you have a business that is absolutely firing on all cylinders. We're talking 23% growth, and it's actually generating cash, not just burning it. But then you look at the stock chart, and it's near multi-year lows. This kind of gap between perception and reality, that's exactly where big opportunities can be found. So, what is Wall Street seeing that we're not? Or maybe, what are they missing? And this slide just lays it out perfectly. It really is a tale of two different stories. On the left, you've got the business story. Solid growth, making money, beating what they promised they'd do. That's the textbook definition of a healthy, growing tech company. But then you look at the story the stock is telling on the right. It's down on the year, sleeping near its lows. It's like the market is reading a completely different book than the one the company is writing.
Now let's put some real numbers to this. The market is valuing this entire company at just about $4.8 billion. Now think about that for a second. In the cybersecurity space, which is booming by the way, a company with this kind of tech and over $1 billion in recurring revenue being valued so low, it's a real anomaly. It just makes you stop and ask, has the market gotten this completely wrong, or is this a massive bargain just waiting to be noticed?
And if we dig just a little bit deeper, this is where it gets kind of wild. The company is trading at about 5 times its revenue. Now, in plain English, a multiple that low in the software world usually screams no growth or big problems ahead. But as we just saw, SentinelOne is growing fast. This one number, this 5x multiple, is really at the core of the whole undervaluation argument, especially when we stack it up against the competition.
So before we get too lost in the valuation weeds, let's back up. Who is SentinelOne anyway? What do they actually do? And what's all this talk about them being an AI disruptor in a space that's already crowded with giants? Well, they're not some fly-by-night startup. They were founded way back in 2013. They had a huge IPO back in 2021, but then, got caught in that whole tech market meltdown. But what's really important is what they've been doing lately. They've been making smart acquisitions like PingSafe to seriously beef up their cloud security. And then, just last month, they exposed that massive Salt Typhoon breach. Finding and exposing a state-sponsored hack of that size, that's not just a product win. That's a public demonstration that your tech is absolutely top tier.
So the magic behind it all is their Singularity platform. The best way to think about it is this. Old school antivirus is like a security guard with a photo album of known criminals. If someone new shows up, they might get right past. SentinelOne is more like an AI-powered detective that's constantly watching for any suspicious behavior, even if it's never seen that specific attack before. And it does this across everything: laptops, servers, the cloud. This approach, being built on AI from the ground up, is what really sets them apart from the old guard.
And their purple AI is the engine that makes it all happen. It basically automates what used to take a whole team of brilliant, expensive humans hours to do. So instead of a security analyst having to write lines and lines of complex code, they can literally just ask a question in plain English like, hey, show me any weird login attempts from outside the US in the last day. And boom, they get an instant answer. In a cyber attack where every second counts, that is an absolute game changer.
Okay, now this slide, this is where that valuation disconnect we talked about just smacks you in the face. Just look at the numbers. SentinelOne's growth, at 23%, is right in line with its biggest rival, CrowdStrike. But then you slide your eyes over to the valuation multiple, how the market values that growth, and it's not even in the same universe. SentinelOne is at 5x, while CrowdStrike is getting 18x. It's growing like a premium company but being valued like it's on its way out. It makes no sense.
So let's really hammer this point home and dive into those financials, because this is where the company's execution really tells the story. We're going to look at the hard data that proves this business is performing, exceptionally well, regardless of what the stock chart is doing.
You just can't argue with the top-line growth. In their last quarter, revenue popped 23% compared to the same time last year. But what I find even more impressive for a subscription company like this is their ARR, annualized recurring revenue, also grew by 23%. ARR is the golden metric because it's predictable. It's not a one-time sale. It shows they're consistently winning new customers and locking them in for the long haul. And all that steady growth is leading them to this, a massive milestone. For the first time ever, SentinelOne is on track to pull in over $1 billion in revenue this year.
You know, crossing that billion-dollar ARR mark is a huge deal in the software world. It's a signal that you've achieved real scale, that the market accepts your product, and it moves you out of that scrappy upstart bucket and into the big leagues.
But here's the thing. In today's market, just growing isn't enough. Investors want to see a path to profit. And this is what's so bullish here. Look at this rapid shift. They now have a positive operating margin and even better, positive free cash flow. This is critical. It means the company is no longer just lighting cash on fire to grow. It's becoming a self-sustaining business that actually generates more cash than it spends.
And all of this strength is sitting on top of a rock-solid foundation. The company has $1.1 billion in cash on hand, with almost no debt. In this kind of weird, volatile economy, having a fortress balance sheet like this is a superpower. It gives them total flexibility. They don't have to go beg for money. They can survive a downturn and keep investing in their future from a position of strength, not desperation.
Okay, so we've established the facts. The business is strong, the balance sheet is a fortress, but the valuation is low. Now, for the really fun part. How does a company worth less than $5 billion today even have a chance of getting to a $100 billion valuation? Let's map out the long-term bull case.
And look, we're not the only ones seeing this. The well-known research firm Citron recently put out a report with this killer quote. Their whole point is that the market is stuck in the past, valuing SentinelOne like it's still a simple little security company, not the full-blown AI platform it's become. And they're putting their money where their mouth is, with a $32 price target on the stock. That's more than double where it's trading now. Now here's a look at how the math could, hypothetically, play out. This is the roadmap to that $100 billion number. We're starting today around $5 billion on that low 5x multiple. Now let's say by 2028 they keep growing and the market just gives them a slightly more reasonable 10x multiple. That's a $16 billion company. Fast forward a couple more years, if they hit $3 billion in revenue and get a multiple closer to their peers, maybe 15x, now you're talking $45 billion. The big leap to over $100 billion by 2035 requires them to become a true leader, keep growing, and earn that premium 20x multiple that the best of the best companies get. It's a long journey, for sure, but each step is logical.
So where does all that future growth come from? It comes from this, the platform strategy. See, they are not a one-trick pony anymore. This chart shows that their newer products, the cloud security, data security, all the AI stuff, now make up about half of all their new business. This is so important, because it shows the plan is working. A customer comes in the door for one thing, but they end up buying 3 or 4 more. And that's what creates that massive growth flywheel.
So, to just boil it all down, here are the 4 key drivers investors need to watch. First, the market just has to wake up and close that valuation gap. Second, they have to keep pushing customers to adopt the whole platform, not just one piece. Third, they need to execute and become a real leader in AI and cloud security. And fourth, if they do those first 3 things, they should be able to take a much bigger piece of this gigantic and growing cybersecurity pie. Of course, it can't all be sunshine and rainbows. No investment is a sure thing, and it's absolutely crucial to look at the other side of the coin. So before we get too excited, let's talk about the risks. What could go wrong? What's the bear case here? And there are definitely some legitimate concerns. For starters, the competition is absolutely brutal. You've got CrowdStrike, and then you have the 800-pound gorilla, Microsoft, getting more and more aggressive in this space. Second, if the economy really slows down, companies might slash their IT budgets, and that would hurt everyone. Third, they did just have their CFO leave, which always creates a little uncertainty. And finally, about 10% of the stock is being shorted, which means a lot of smart people are betting the price goes down, not up.
But, and this is a really big but, here's the counterbalance to all those risks. Remember that fortress balance sheet? With $1.1 billion in cash and positive free cash flow, SentinelOne isn't some fragile company that's going to keel over in a tough market. They have the financial firepower to fight these competitive battles and to weather an economic storm. That cash is a massive safety net against a lot of the bear arguments.
All right, let's wrap this all up. We've looked at the company, the strong financials, the very exciting long-term bull case, and the very real risks. So, where does that leave us? What's the final verdict? It really all comes down to this single question. We have a company that's successfully reinventing itself as a cutting-edge AI platform. It's growing fast, it's making its own money, and yet, for some reason, it's trading at a massive discount to all of its peers. The disconnect is undeniable. The question you have to ask yourself is that discount justified, or is this truly one of the most compelling, undervalued AI stories hiding in plain sight right now? Now, before we go, the important disclaimer.
The content in this presentation is for informational purposes only and is not financial or tax advice. You should always do your own homework and talk to a professional before making any investment moves. Our goal here is to share interesting ideas and break them down for you. Please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. And one more thing, please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities. Thanks for watching, and we'll see you on the next one.